Welcome to Chapter 17 of the Wealth Management Essentials course. In this chapter, we will be looking at investment management. So there are 6 different learning objectives. We will be looking at a systematic approach to investment management, individual securities or managed products. We'll also look at portfolio theory and international investment. So first, we're going to start with asset allocation. Strategic asset allocation, it basically just refers to the asset mix designed to achieve the client's long-term goals and objectives. So it is sort of that benchmark asset mix that you try to target for a specific client. If they are looking for more long-term growth, it would lean more towards equities. If they're looking for more stability and safety, it'll lean more towards cashable investments or cash and bond funds. So an example, a client's strategic asset allocation could be 5% cash, 25% bonds, and 70% equities. A constraint may be that only 25% of the portfolio will be allocated to non-North American equities. So there can be some constraints put on as well. Now rebalancing, so this happens quite often. So a portfolio's actual mix, it constantly changes, and rebalancing the portfolio becomes necessary when the client's actual asset mix drifts too far from the strategic asset allocation. So in the example, equities typically would grow more than the bonds and cash portion. So you would expect to see that equities portion grow from 70% maybe up to 75, 80% throughout the years. And so you would expect to maybe cut back on some equities and move it over into bonds and cash every once in a while. Now, a tactical asset allocation, that's a strategy of altering the strategic asset allocation to take advantage of short-term fluctuations in the relative performance of asset classes. So there are certain strategies where you can alter that. So for example, if someone thinks or an investor thinks that we're headed into a year where cyclical investments will do quite well, then they might move a little bit of the cash and bond portion over to equities to buy more cyclical investments. Vice versa, if the economy is doing quite well and they're expecting that maybe there's going to be a difficult year in the markets, they might lean more towards bonds and cash as opposed to equities. So having that tactical asset allocation gives the fund manager a little bit of flexibility in terms of the mix that they are looking to take. So the steps to investment management, first you would choose a strategic asset allocation. Number 2, you would select individual investments to actually implement that asset allocation, and then choose an investment strategy. So quite often it could be leaning more towards active investments or passive investing. So active is just when you're sort of moving in and out of different investments. You're not just an index. So you might buy or overweight the portfolio in some different areas, whereas passive investing is sort of just mirroring an index. So if there's ever a change in the index, you make the same change right after. So you're always your benchmark is that index that you're following. So quite often you might see an index fund based on the S&P 500. Well, it's basically trying to track that. So it would do that to some degree. It might lag it a little bit just because there is usually management fees and there is that lag or delayed effect in the passive investing strategy. The 4th step is obviously just monitor and evaluate the portfolio. So you will want to review it maybe once a year, and if there's any rebalancing that needs to be done, you can do that at that time. Now we're going to take a look at managed products versus individual securities. So the really main key difference to managed products is the diversification benefit. So generally, managed portfolios are more appropriate when the portfolio has a smaller dollar value. And the reason for that is, say a client has just $10,000 to invest. You could put that $10,000 into a managed product like a mutual fund, where it is invested in hundreds of different investments. Sometimes it can even be thousands. So you're basically invested in the markets in general. So if the markets go up, you're going to make money. If they go down, you'll probably lose some money. But over time, we know that the markets do quite well, and that's why you would invest in that type of strategy. It has the stability, and we're quite sure it's going to grow. You could also buy individual securities, so that could be, let's say you maybe buy $5,000 in Apple stock and $5,000 in Royal Bank. So you have two different stocks. There isn't much diversification just because, if one of those two stocks do poorly, that's half of your portfolio. And so when you have a smaller dollar value, it makes more sense to buy those managed portfolios for the diversification. But then as your dollar value or portfolio value grows, it might make sense to add a stock or two. Clients' risk tolerance is another thing to keep in mind. So some clients, they are uncomfortable with individual securities, especially equities, because they believe they are too risky. Also equities, they tend to be more volatile, so they can definitely have much more fluctuations depending on the investment you're looking at. But it's not that uncommon for a stock to go up or down 10 or 20%. Last year you had the banks go down. Some of them went down about 20%. This year they're down 10 to 15%. So it definitely can happen, even with a pretty solid and secure stock like a Canadian bank. Also, clients' previous experience does play a factor. So clients who have had a bad experience in either managed portfolios or individual securities may be unwilling to do so again. Clients need to control the timing of taxable transactions. That's another reason managed products, they do not offer control of taxable distributions. Usually they just pay out distributions. It could be monthly or annually. And at the end of the year, they'll send out their tax slips, and you don't really know, how much the distribution was. It's sort of up to them. So if a client needs to be wary of the taxable income that they are going to be earning, then sometimes you might want to choose a stock so you can mostly predict either the dividends that they're paying out, or maybe you just buy a stock like Amazon, for example, that doesn't pay any dividends, and you're just looking to get some capital gains on that, and you'd only have to trigger that capital gain when selling. Another thing is advisors' access to timely, accurate research on individual securities. So advisors are not professional analysts. Their ability to recommend individual stocks is related to their access to good information and the trust in these research tools. So sometimes advisors might not have that, and so they might not have a great recommendation for individual stocks. Next, we're going to look at portfolio theory. So modern portfolio theory originated in a paper by Harry Markowitz. It was called Portfolio Selection. He developed a mathematical definition of portfolio risk, which is the standard deviation. Using this definition, he created a procedure to identify the makeup of portfolios that optimize the trade-off between risk and return. So basically, a portfolio expected return is equal to the sum weighted of the expected return of the individual investments. Now, risk is the standard deviation of returns. So the portfolio risk is usually less than the weighted average of the standard deviation due to reducing non-systematic risk, which is individual stock risk. And this is because some investments are negatively correlated. And so as you can see, I listed the standard deviation calculation for a portfolio. It is important to remember this for the exam, as it's most likely that it will be on there. Now, just going through a quick example, you could use that portfolio to try and calculate some of these, but you can see that the portfolio standard deviation It does tend to increase when the weight in stocks increases. But as you can see, a portfolio that is fully in bonds has a standard deviation of 8%, whereas a portfolio with 90% bonds and 10% stocks has a lower standard deviation in 7.87. So that is a bit contradictory. You would think that a bond portfolio has lower risk than stocks, but because stocks and bonds are somewhat negatively correlated in some ways, it does make sense to have some stocks in a portfolio to lower the risk. So that 90-10 portfolio is actually riskier or less risky than the 100% bond portfolio. And this goes into portfolio theory. So you can see the chart of the efficient frontier, and then you can see that the standard deviation or risk actually lowers a bit with some exposure to stocks, while the expected return also increases. So the most efficient portfolio may be in between 90% bonds and 10% stocks, and 80% bonds and 20% stocks. And you can see as the correlation to the stocks and bonds differ, so does the efficient frontier. So the minimum variance frontier, it is a set of portfolios with the lowest possible risk for a given level of expected return. So on the graph, you can see it's the upper end because that's where the expected return is higher for that level of risk. The MVP for a portfolio of stocks and bonds with 0.5 correlation is 15% stocks and 85% bonds. Many investors believe that 100% bonds is safer, but having some exposure to stocks does lower the overall portfolio risk just because of that correlation. So in building a portfolio, you want to try to stay closer to the efficient frontier, which is the red line. Now looking at the capital asset pricing model, or CAPM, so this is another formula that would be good to know for the exam. So the creation of CAPM is usually attributed to William Sharpe. CAPM first introduced concepts such as a market portfolio, beta, systematic risk, and unsystematic risk. If beta is equal to 1, then its systematic risk is the same as the market, meaning its risk and return is equal to the market. If beta is greater than 1, its systematic risk is greater than the market. If it's less than 1, the systematic risk or market risk is less. Now, beta is calculated using regression analysis with historical data. Usually in a question, if you do have it on the exam, they will just give you the value for beta. Now, the coefficient of determination is also known as R squared. The value of R squared can range from 0 to 1. A value of 0 means that the return on the security or portfolio and the return on the market index are unrelated, and therefore none of the variability in the security or portfolio is explained by the variability in the market. If the value is 1, then it means that the return on the security is perfectly correlated, either positively or negatively, with the market index. Therefore, all the variability in the security is explained by the variability in the market index. So that is another thing to remember for the exam, just the difference between 0 and 1. International investing, so the CAPM and modern portfolio theory support the inclusion of foreign investments in a well-diversified portfolio. Since the 1970s, international investment has seen a rapid growth for several reasons. One is deregulation of the financial markets of the major industrialized countries. Also, development and growth of global and multinational companies and organizations, explosive growth of international capital flows, and the concurrent abolishment of foreign exchange controls and advances in information technology. International investing does have its advantages and disadvantages. Advantages include better diversification, exposure to emerging markets, and exposure to unique companies. Some disadvantages, though, include higher expenses, sometimes some liquidity risk, poor shareholder communication, foreign exchange risk, sovereignty risk, and different legal and accounting basis. So those are all the main topics for Chapter 17. I will see you all in Chapter 18.